We have this picture of an investor as this cold, calculating machine, right? Just laser focused on one thing, maximizing wealth. But is that really the whole story? Today, we're going to dig into behavioral portfolio theory to see what actually drives our investment decisions. We're going way beyond the balance sheet into the messy human world of principles, emotions, and, the huge rise of ESG.
So, here's how we're going to break it down. First, we'll challenge that classic idea of the rational investor and look at what people really want. Then, we'll nail down what responsible investing actually means. That's going to lead us right into the central tug of war, profit versus principles. After that, we'll see what the data says, and it's a bit of a wild ride, before wrapping up with a really powerful idea that might just bring it all together.
All right, let's kick things off by really questioning that old school image of the investor who only cares about the bottom line. It seems like such a simple question, doesn't it? If the answer was just more money, well, finance would be a whole lot less complicated. The truth is, our motivations for investing are way more complex and, frankly, way more interesting than that. See, behavioral finance tells us we're not just chasing a single number. Our portfolios are almost built in layers, and each layer is trying to satisfy a different want. It might be the good feeling you get from supporting a company you believe in, or maybe the comfort of investing in companies you know. And yeah, for some, it's the thrill of swinging for the fences, hoping for that one massive home run. Okay, so let's zoom in on one of those wants in particular, that desire for social responsibility, and unpack how it actually shows up in the world of finance. So, the big idea behind socially responsible investing, or SRI, is that it has this dual mandate. It's not just about financial return anymore. It's about financial return and social or environmental good. And trying to serve both of those masters at the same time, well, that's where it gets really interesting. And this is a super important distinction. People come to SRI from two totally different directions. You have the values-based folks. For them, it's simple. They invest this way because it lines up with their moral compass. End of story. But then you have the value-based crowd. They believe that companies with strong ESG practices are just better businesses and that they'll outperform financially in the long run. So, what does this look like in the real world? Well, an SRI strategy is kind of doing two things at once. It's actively looking for companies that are crushing it in areas like protecting the environment or promoting diversity. At the same time, it's screening out entire industries, think tobacco, weapons, stuff like that just don't align with its core principles. And this, right here, brings us to the heart of the debate. When you start weaving your personal values into your portfolio, are you automatically giving up some performance? Let's get into that conflict. This is the classic dilemma. Do you separate your money-making from your world-changing? In other words, should you just go for the highest possible return you can get, no matter where it comes from, and then donate a chunk of your profits to causes you care about? Or do you bake your values directly into your investments from the very start? This choice really reflects two totally different views of the world. Standard portfolio theory says, hey, don't tie one hand behind your back. Go make as much money as you can, and then use that money to do good. But the behavioral wants frontier says, hold on, for a lot of us, how we make our money is just as important as how we spend it. That emotional benefit of investing in something you believe in, that's part of the total return. And this isn't just some fringe academic idea. Look at this. A full 30% of affluent investors are already operating this way. They're actively factoring social responsibility into their decision-making. That shows you just how powerful this behavioral model really is in the real world. Okay, so the theories are great, but what happens when the rubber meets the road? What does the actual data say? Does investing with your conscience tank your returns? Let's follow the evidence. So does it work? Well, the honest answer is, it's messy. The evidence is pretty much all over the map. You can find smart, credible studies that will tell you completely opposite things. So on one side, you have this famous study that found so-called sin stocks, alcohol, tobacco, gambling, actually delivered higher returns. The theory is that because so many investors avoid them out of principle, their stocks get neglected and become undervalued, creating an opportunity for those who are willing to buy them. But then, on the flip side, you have compelling research showing the exact opposite. Another well-known study found a clear, positive link between treating your employees well, a key social metric in ESG, and generating higher stock returns. Companies on the best companies to work for list consistently outperform their peers. So what are we supposed to make of all this? One study says one thing, another says the opposite. Well, this last section offers a really interesting way to maybe reconcile these two ideas by thinking differently about what a company is even for.
I love this quote from Costco's founder, Jim Senegal. He just nails it. What he's saying is, sure, you can probably juice your short-term profits by squeezing your employees or your suppliers, but that's not a long-term game. To build real, lasting value, you have to take care of everybody involved. And this real-world philosophy actually has an academic name. It's called stakeholder theory. The idea is that a business's job isn't just to make shareholders rich. Its purpose is to create value for everyone it touches, its employees, its customers, its suppliers, and the community it operates in. From this point of view, strong ESG performance isn't a trade-off against financial performance. It's the very foundation of it.
And that leaves us with the million-dollar question. Is ESG a compromise, a sort of conscience tax you pay on your returns? Or is it simply the smartest, most modern way to find the companies that are built to last and create durable, long-term value? The jury is still out, but how you answer that question for yourself will say a lot about the kind of investor you're going to be.